Hello, everyone, and welcome to another episode of the Business Growth Show, where we talk about all components of business and how to utilize them for exponential growth. My name is Athin Cassiotis. I'm a serial entrepreneur, international speaker, results strategist, business coach, mentor, and consultant. Today, I have an awesome guest. He is a tax and business advisory partner at Grant Thornton Australia, based in Sydney, Australia, specializing in providing CFO, business advisory, tax advisory, and tax compliance services to multinational companies, both inbound and outbound. He's also passionate about helping Australian startups to scale up and expand internationally. He focuses on the technology, media, and FinTech sectors, and his 30-year career to date spans across assurance, accounting, taxation, consulting, and business advisory services, where he has worked with public companies, international subsidiaries, private companies, family businesses, and high net worth individuals in Australia, UK, and Southern Africa. Welcome, Raj Deepan, and thank you for being on my show.
Thank you, Athin. It's wonderful to be here, and look forward to spending some time with you and your viewers this morning.
Awesome, mate. I'm sure it's going to be awesome, and so much value is going to be shared today. So, you're very successful. So, for those people who don't know who you are, just please introduce yourself by telling us about you and your journey.
Thanks, Athin. So I started my career 30 years ago in London in a company called Coopers & Lybrand before it became PricewaterhouseCoopers. I was one of 1,000 graduates who started that year. So as you can see, it was a big number. It was hard to make a big name for yourself those days because there were so many people starting in the firm. I was in the banking and financial services sector when I started. Auditing large insurance companies and banks in London, which is obviously the financial hub of the world, and I probably still is. Then 3 years into my career there, I got a transfer to South Africa with PricewaterhouseCoopers, and I worked there for 7 years, again in the audit environment, and also a bit of consulting towards the end, leading up to the Y2K, the Millennium Bug. I think a lot of people might remember that, but some of the audience may not even know what the Y2K bug is, but so leading up to the millennium, which was the year 2000. And then I got married in 98, and my wife wanted to explore new areas. So we thought, okay, we either go back to the UK or come to Australia. And so we ended up coming to Australia in the year 2000, which was the year of the Sydney Olympics. And the year the new Australian tax system came in, the ABN system and GST. John Howard introduced the GST that year, and he got it through Parliament. Obviously, we still have the GST. 20 years or 21 years, or no, actually 22 years now. I think that's 22nd year now in Australia. And since coming to Australia, I actually got into, before coming to Australia, I was looking from an audit perspective and a consulting perspective. But after coming to Australia, I got more into working with the businesses in terms of advising them, in terms of their structuring, in terms of tax and so on. So I got more into, before that, I never looked at tax, and now tax is a big part of what I do as well now. So 21 years now in Australia. Became a partner in 2009, Athin. So I was at BDO then, and in 2012, BDO came into Grant Thornton. Just to give you a little bit of background about Grant Thornton. Grant Thornton is a global accounting firm. We are in 135 countries. Our revenue is about 6 billion worldwide, and multidisciplinary accounting practice. Headquartered, our CEO is out of the UK. Our biggest firm is in the US. And Australia sits in the top 6 in terms of the firms in the network out of the 135. And then as I said, 2009 became a partner. And then my first job, I don't know whether you want me to talk about this now, Athin, but my first, if that's okay, my first job was Facebook. So Facebook was setting up in Australia that year, 2009, believe it or not, the year of it was just after the financial crisis. So it had been pushed back 1 year. And the partner I was reporting to said, Raj, go and tender for the Facebook opportunity to set up Facebook in Australia. And that's been my cornerstone client. I've been with them now for 12 years. They're in the city. I'm in the city, in the Sydney CBD, and they're just around the block where I think they're where the iPhone shop is. So Facebook has grown from 1 employee. We brought in I still remember the first employee who came to Australia. We helped him with his visa to come into Australia. We set the company up. We got the registrations. We got them trading, right? And now we are about 150, 160 employees. We had $1 turnover, 0 turnover in 2009 out of Australia, and now we have like a $1.5 billion company Facebook globally is a $70 billion company, and 1.5 billion now in Australia. So it's been a very interesting journey. And along the way, I worked with lots of interesting people, and we've transitioned the company from, say, a startup, virtually a startup in Australia, to where it is today. So maybe I'll just stop at that, Athin, but that gives you a bit of a flavor as to my journey to date.
Yeah, awesome, Raj. Thank you so much for that. Amazing journey across, multiple countries, and now being in Australia for 22 years. And yeah, amazing with Facebook, biggest, social media platform to get them in Australia, starting from day one, and how you've grown them over this time. So really, really powerful. Thank you for sharing, Raj. And okay, let's now start with domestic base structures. So initially, Raj, for people that, a little bit early on in understanding how this works, what options do we have to sort of structure things in Australia?
Yeah, good question, Athin. And I think you mentioned at the start when you introduced me, in the last 5 or 6 years, we've started working with a lot of startups in Australia. So we've seen obviously inbound companies being very successful, like Facebook I mentioned. I work with Square as well. I think everybody knows Square, and Square has just done a deal to take over Afterpay. That transaction went through on the 1st of February, I beg your pardon, 1st of February. So we are not going to be involved in consolidating Afterpay and Square in Australia. Having seen a lot of successful companies, in my career, mainly coming out of the US and UK and Europe as well, and some extent in Asia as well, I got interested in, scaling up and working with Australian startups. And when Malcolm Turnbull came into power, I was talking about Innovation Nation. We were all jumping onto the bandwagon. Let's help Australians, companies go and expand overseas and be successful. And we've had a few of those, right? Afterpay obviously is one. Canva is another one. Atlassian, obviously very well known. Atlassian, I think I recall talking to somebody who said Atlassian was a concept in 2005, I think. 2005 was a concept, and they won an award for their concept. And in 2015, the two founders were worth $10 billion each. So they're gone. So we wanted more successful stories. So anyway, so then we got in this whole area of helping Australian companies, set up and grow, and also working with some domestic clients, high networks, and so on. So to come back to your question about structuring, so the basic structure is if somebody has an idea, or it's a basic thing, we might say, start as a sole trader or a small operator. So for me, no client is too small. So I do work with a small end of town as well, because I enjoy working with passionate people, just like yourself, Athin. At the lower end, you might say to the client, look, you start off as a sole trader, see how we go. The risk guy as a sole trader is that then you take the risk. If something goes wrong, then you're personally liable. So that's your basic structure. The next one is a partnership, where two people get together, two founders maybe may get together and say, I've got an idea. So that's sort of a fairly straightforward structure. You've got a partnership agreement, you get an Australian business number, and you start off in business. Again, you don't get the limited liability because you're still personally, jointly and severally liable. So there's a bit of a risk there. If one of your partners gets something wrong, then you could be personally liable for that issue as well. So then the third thing is a simple company structure. Generally with startups, we are going with a company structure because it gives you limited liability. There'll be a couple of founders to start with. Then they might give some capital to family and friends, early stage capital, and then they're raising Series A, Series B, Series C as they grow, right? So the company structure is a formal structure that the private equity firms, the venture capital firms understand. And it's fairly straightforward to set up. It gives you limited liability, and it's a good way to start. And then lastly, I might mention trust. So trust is more of an investment vehicle, Athin. So we generally try to split the operating business from the investment side. So let's say, Athin, you're running a business, obviously you're running a business, which is the growth show and so on. So that's your business where you generate income, and you might have some expenses, you're growing that business, you're bringing people in, but then you're making money. And then how do you invest that money for retirement and for your retirement and for your savings, right? So that's where we bring in trust. So trusts are a good way to invest money, allows you to distribute the money to your spouse, to your children, to family members. So there's some tax planning around that. You might genuinely be supporting your parents, so you can distribute to them, right? Brothers, sisters. So there's a whole family concept within a trust. And linked to the trust is also a special type of trust, which is a superannuation fund. So obviously, superannuation funds are also very tax-effective planning mechanisms. So in an ideal scenario, I'll talk about a client very quickly. He was a director of a big engineering company. Retired. I remember he retired probably about 10 years ago when he was 60. And I think he had acquired shares in the company. There was $7.5 million worth of shares in the company through his career. So he sold those as part of his retirement. And then today, if I look at him, he has got money in super. He's got about $10 million in super, about $10 million in a trust, right? He's got 4 children, 10 grandchildren. So all the grandchildren are now beneficiaries of this trust. All the grandchildren between like 0 and 5 years old, very lots of young grandchildren. And then, he's got a super fund trust, and assets in his personal name, property in his personal name. So that's an ideal structure that we see when somebody retires. They'll own the property in their personal name. They'll have assets in a trust they can distribute to family members, including children and grandchildren, and they'll have money in super to fund their retirement. And then subsequently we talk about with him, we have sat down in the last couple of years, done his estate planning, done his wills, so all the children are aware what will happen in the case they pass away. And so that way we keep that separate from the business. So the business operates, the business could be finite, Athin, as you know. You might sell the business very quickly, you might make $100 million. Some of the entrepreneurs are making money very quickly, they might sell very quickly, others might run it for a long period of time. But in terms of your lifestyle, you need to fund that for obviously until you live or your spouse lives, and then obviously beyond that to your children, right? So they are the structures, and there are different considerations for each of them, right? And every time we sit down with the client, just like a financial planner would do to understand the financial planning, goals that they have, we'll understand their business goals and their wealth creation goals in coming up with an appropriate structure, right? So, and structuring can be key. The difference between, structuring correctly and incorrectly can be millions and millions of dollars, right? So it's important to get it right.
Yeah, definitely. Thanks for that, Raj. Definitely giving us a whole breadth of knowledge about all of those different structures, which is awesome. So let's get into it a little bit more about investments then, right? Because, you mentioned a bit about property, there's shares, there's a lot of different ways that we can do this. Now, where should we buy these things? Because I know, for example, there's a lot of various taxes, that we have to take into consideration, how they're passed down and things like that. Like, you can have a property in a personal name. You could also have a property in a trust. Where do we put shares and things like that? So do you want to maybe tell us a little bit of some of the tax considerations when we're thinking about, structuring these investments?
Yeah, a good question, Athin. And the biggest consideration is capital gains tax, right? So we went through capital gains tax reform about 20 years ago. So now basically what it says is that if you own a property either in your personal name, in a trust or a partnership, you held the property for more than 12 months. And when I say property, it could be shares, it could be real property, it could be unit trust, it could be a managed fund, whatever, any type of investment. If it's held for more than 12 months, you get the 50% discount. So you buy shares, let's say 100,000 today, and you sell it for $200,000. After a year, so you made a gain of $100,000, but you only pay tax on 50,000. So previously we had indexing, where used to index the cost base every year by CPI, it should go up by 3% or whatever it is every year, right? So that indexing was frozen and replaced with now what you call the 50% discount. So typically, let's say we're just talking to property. I think you talked about property. So we normally say, okay, the biggest consideration now is capital gains tax, right? Let's have a look whether we can put it in a trust, a partnership, or an individual. We normally wouldn't recommend a company because companies don't get the 50% capital gains tax exemption. So that's the first consideration. The second one is negative gearing. And we all know about negative gearing. That's when the expenses are more than the revenue, right? So you make revenue from your property, which is your rental income. You've got your deductions, which is your interest, depending on how much you borrowed. Then you've got depreciation, you've got maintenance, you've got council rates, water rates, strata rates, whatever, right? So if your expenses are more than your income, you're in what we call negative gearing, right? So let's say rental income on a property is, let's say, $30,000, expenses are $40,000, so you got negative $10,000, right? So if you were to put in a trust, that $10,000 is carried. You don't lose it, but it's carried forward every year. So you can't offset it, right? Whereas if you put in a partnership or individual name, you can offset that $10,000 loss against income you make from other sources, whether it's from your business, Athin, you mean a sole trader, or PAYG employee earning salary. So traditionally, that's why people have created wealth, right? Through the 80s, 90s, and now 2000 and 2020s now, right? Is because of this negative gearing concept, right? People went and started saying, okay, let me negatively gear, offset some tax, and actually get tax back. So even though you're making a loss of $10,000, you might get $5,000 tax back. So effective cost is $5,000, right? So you're topping up now $5,000 to keep that property, right? which divided by 12 months might be $400 a month. So very affordable, right, to own a property. And then you get the capital gain, hopefully, and to the 90s and 20s, properties appreciated significantly, and then you got the 50% discount, so it all makes sense. You're creating wealth, right? The last thing to consider is land tax, right? Because land tax, on your home you don't pay land tax, but if you own an investment property, you do pay land tax. And the land tax rules are state-based rules. There's capital gains tax and negative gearing are federal rules, right? The federal government, controls that, whereas the states control land tax, right? And it is their mechanism to collect tax. And when property is going through, through the roof, the state authorities are very happy. They're just, bring the money in, right? Because every transaction they're collecting land tax, they're collecting stamp duty, and so on. So land tax consideration is, if you buy a property in your personal name, the first, I think roughly is about $470,000. It changes every year. In land value is land tax free. Otherwise, once you go above $470,000 in land value, you're paying land tax at about, I think the rate's about 1.5, 1.6%, right? So what we generally say to people is, in order to access that first $470,000 tax-free amount, let's say it's in yourself, you and your partner, you say, okay, we're looking to buy, we've got a home, want to buy an investment property, we will suggest you buy in your personal names. So it'll be buying in you and your spouse's name. You'll buy a property together, right? So you get the negative gearing, so you can offset it against your incomes. You get the land tax saving, right? And then when you sell, you get a 50% discount. So that works. Whereas Athin, tomorrow you say, my dad gave me $1 million. I just want to go and put $1 million and want to buy shares or property. We might say buy it in a trust, right? Because there's no negative gearing, right? It's going to be positively geared, right? You already got the land tax concession on the first property that you own with your spouse. So now you got it in a trust. And the benefit of that is, because it's positive income, you don't want to distribute that to yourselves and pay tax at your highest marginal rate. Maybe potentially, if you're earning more than $180,000, you can now bring into play your children, brothers, sisters, and so on, to reduce that tax, right? So generally, to answer your question, then capital gains tax, negative gearing, land tax, general rule around property, your home is in your personal name, right, or your joint name with your spouse, because that is capital gains tax exempt and is land tax exempt. So basically, any equity you create in your home, when you sell, no taxes. You buy a house for $1 million today, sell it for $3 million in 20 years time, the $2 million or the profit you get to keep, no taxes paid. So home is in your name. Investment property, the first one or the first two can be in yours or your spouse's name. To access the land tax concession for both of you, you would buy one investment property in your name and one in your spouse's name, not joint names. So let's say you want to buy two, you've got two sons, right, or two daughters. I don't want to be sexist, a son and a daughter, right? So you want to buy two investment properties, one to give them each when they're starting their lives. You might buy one in your name and one in your spouse's name. That way you access the land tax concession for each of you, and you get the negative gearing. And then thereafter, from the third property onwards, you buy it in a trust.
Yeah, great. Thanks, Raj. Really awesome there. And one thing that just got me thinking, I think is a great question for you as well, is that obviously, we want to buy, like you said, later in the trust with these properties, right, for the wealth creation element. Now, if for some reason, we still had a negative gearing strategy, right, for that. Now, if we were to have shares or something else in that same trust, which obviously we were going to get a benefit from that, where they would increase over time, then that would be offset against the negative gearing element. So we would be able to get the benefit of that at the same time. Is that correct?
Yeah, I think absolutely. And it's a very good tax planning strategy, Athin, right? So because let's like you said, take the example, you got $1 million investment property in a trust and you got $1 million share portfolio earning dividends, right? So one is, let's say, makes a loss of $10,000. The share portfolio returns, let's say, I don't know, $50,000 in dividends and whatever. So you can offset the dividend against the $10,000 loss and then distribute the net $40,000 and get the benefit of franking credits, right? So that's the other tax planning thing, is the franking credits. The Labour government was talking about abolishing franking credits or the ability for people to claim back excess franking credits, right? So let me simplify the example. Let's say, you had $10,000 in rental income, right? And $10,000 in negative gearing and $10,000 in frank dividends. You offset the two. As long as there's $1 left over, you would distribute the $1 to Athin. Let's say to you, Athin, you had a trust earning $10,000. in investment income, $9,999 in rental, rental negative gearing, $1 surplus. I distribute that to you, Athin. You get a distribution of $1, but you get to claim back the $3,000, let's say, if it's a fully franked dividends that you've been earning, and the franking credits attached to that are $3,000, you're actually now not only offsetting the losses, right, and not paying tax on the dividends, you're in fact getting tax back, being the franking credits attached to those dividends. So generally, yes, in trust, right, we do see when you're creating an investment trust for yourself for retirement, we are seeing a combination of assets in there. You would see your property in there, you would see your shares in there, unit trust, it could be loans to anybody, let's say loan to a small business. It could be shares that you buy in a startup with the potential to give you a good return, a capital gain. So you would have a whole mixture, right? And we don't really advise on this, we work with financial planners. So because we're not allowed to as accountants to advise on financial planning strategies, but when you sit down with a financial planner and they work out your goals, they'll talk about your risk and where do you want to invest $18, and let's say it's $1 million, they'll split it up into these different categories. So you're spreading the risk, right? Also able to offset one against the other. So over a period of time, you're benefiting from both income and capital gains.
Yeah. Awesome, Raj. Thank you for that. That's awesome to go a little bit deeper on that because really powerful to understand how we can save tax and money as well and get stuff back in that way. So you touched on superannuation, right? And tax there before. So obviously that's a vehicle for wealth creation. And there's a couple of, there's the standard way, there's like self-managed, right? From my understanding as well. So, and there's different tax benefits, obviously with super compared to normal tax of what happens, in companies and our wages and things like that. So do you want to maybe talk a little bit about the tax benefits of super and when we can access it tax-free as well as we get older, especially if we're sort of running companies and things like that as well?
Yeah, so superannuation is very powerful, right, Athin? And the government brought it in so to take the reliance of the public funds, right? So they wanted people to start saving for their own retirement, right? And they've imposed, as you know, there's a 10% what you call super guarantee. So if you're employed by somebody and you earn $100,000, they had to put $10,000 into your super fund. That's compulsory. And the rules are recently updated, Athin. I think it's fresh off the press now. Previously, you had this $450 exemption. So if you earn less than $450 a month, I don't think anybody's earning less than $450 a month, but if you did, you didn't have to contribute to super. Whereas now, because people have multiple jobs, they could be earning 400 somewhere, or 1,000 somewhere. On every dollar earned, you'll get your 10%, right? So that comes in. That's already coming in. So you're basically, when a young person starting at 18 is now earning $300 working at McDonald's or whatever, we'll get super put into their super fund, which is really good, right? So you start at 18, by the time you retire at 60, you're building, and the super actually builds over time. So whilst you're in accumulation phase, you're paying 15% tax, 18, right? So that's a big advantage. So if you're earning money, let's say in your personal name or in your trust, you could be paying tax on the earnings at 45%, right? Which is the highest marginal tax rate. Whereas in a super fund, you're paying 15%. So it's a very concessional environment. And then also when super funds make a capital gain, right, when they're selling your fund, whether it's a retail fund or a self-managed fund, your trustee could be buying and selling shares, the capital gains tax is 10%, right? Whereas in your personal name, on a highest marginal tax rate of 45%, because as I mentioned earlier, you get the 50% discount, you're paying 22.5% tax. That's your highest tax in your personal name, whereas in your super fund, you're paying 10% tax. So it's very concessionally taxed, which is allowing for the fund to grow, right, over a period of time. And the idea is that it'll grow, and then they're brought in these what's called reasonable pension limits. So the concept is that a person would try and accumulate about $1.6 million. I think it's about $1.65 million at the moment. It gets indexed every year, right? And that amount of money, when it gets converted to pension, so being a couple, at today's rates, we're talking about $3.2 million. 1.6 times to 3.2 million. So you get to 60, 18. I know you're a long way from that, 18. You're probably 30 something now, right? You get to 60, right? And you and your wife say, okay, we're retiring. We're going to put our shoes up. We're going to travel the world. We're going to spend time with our grandchildren. We're going to have fun, right? And you've got 3.2 million. Let's say you've got $3.2 million now saved in your super. That you flick the switch at that point and say, you say to your super fund trustee, whether it's self-managed or retail, that we're going to pension phase. We are retiring, we're going to pension phase. What that means is that from that point forward, from 60 onwards till 120, there are some people think that we will be living to 128. I'm not sure that I want to live to 120, but there are people out there saying with all the technology and the advancement, so that money is going to be tax-free. So $3.2 million, let's say conservatively, earns you 5% return. 5% on 3.2 million is $160,000. So between you and your spouse, you're earning $160,000 tax-free for the rest of your lives, right? And then you can draw that $160,000 to live on as well. So the super fund trustee can pay that to you as a pension for you to live on, and that's tax-free as well. So think about it this way, $3.2 million, earning you $160,000 a year for the rest of your lives, right? You're drawing the $160,000 to live tax-free, and you're not even touching the capital. The capital is sitting at $3.2 million. And it also allows you to draw a lump sum anytime. So if there's an emergency, let's say a child wants some money, or you want to take some money and give to your child $500,000 to buy a property, or there's a medical emergency, or there's a big operation required, whatever it is, give some money to your parents, right? Or you want to travel the world first class and do whatever you want to do for a couple of weeks or couple of months, whatever it is, you can draw a lump sum. Couple of $100,000, $300,000. So that's tax-free as well, right? So everything is tax-free from the time you're 60, right? And they're also brought in this transition to retirement pension, which at 55, it was brought in to encourage people to stay in the workforce. Because what happened is people want to stop and working 5-day weeks and want to start working 2-day weeks or 1-day week or whatever it is, right? And but they couldn't survive on that, sorry. They couldn't survive working. Somebody earning $100,000 working 5 days a week, now earns only $30,000 or $40,000. So in order to bridge the gap, they allowed you to access your super at 55. So you can access your super now at 55 under a transition retirement pension. And the last thing I'll say is, in terms of accumulation, your employer will contribute 10%. So if you're earning $100,000, let's say $200,000, that's probably a better example. Let's say $200,000, your employer is contributing 10%. They're putting in $20,000 into your super fund 18, right? But your contribution limit at the moment is $27,500. So you could salary sacrifice an extra $7,500 to get it to $27,500. And that's up to you. You got to work that out, whether that's going to make your financial affairs work, right? But basically, you can go to your employer, or if you're self-employed, you can contribute personally an extra $7,500, right? And reduce. So let's say, by doing that, you're saving tax as well. So you go to your employer and say, okay, salary sacrifice, take an extra $7,500 off my salary and put it in my super fund. Because on that $7,500, if you earned it, you're paying 45% tax. If the super fund goes in super fund, it's paying 15%. So that allows you to build up your super faster. And they also have, and those are called concessional contributions, where you save tax, right? And the super fund pays tax at 15%. And the last thing I'll say is there's something called non-concessional contributions, where you can say, okay, I want to just park $100,000 in a super fund. So the limit is $100,000. So you can park $100,000 in a super fund. And again, the example I used earlier, Athin, let's say you're a beneficiary from your parents' estate, right? You get, let's say, $500,000. You can say, look here, out of the $500,000, I want to boost up my super. I want to put in $100,000, but in fact, I want to bring forward 2 years. There's a bring forward rule, which allows you to put 300 in. So you get 500, you might say, okay, I put 300 into my super fund as what we call a non-concessional contribution. So you don't get a tax deduction. The super fund doesn't pay 15% tax. So no tax saving for you, no tax for the super fund. But rather than invest that 500,000 in your trust, potentially, you're putting 300,000 into your super fund, right? Allowing you to build that money up to that 1.6 million. So people need to assess, depending on where they are in their journey, right? Whether you're starting at 20 or whether you're now at 40, depending on the balance in your super fund, right? You might want to boost it up. Again, as I say, this is something that people need to work with their financial planners. I mean, we can say from a tax perspective what the advantages are, but ultimately everybody's finances are different, and their commitments are different. So they need to sit down with their financial planner, work it out, because the only disadvantage with super, Athin, is that once you put it in, you can't access it, right? Once you put it in, you can only access it, freely at 60 or under a transition retirement at 55, unless you have an emergency. Unless you have a huge emergency, your financial distress and so on, then you can write to the trustee, and there are certain, what they call early withdrawal. There are certain concessions under which you can early withdraw. Otherwise, you should generally understand that this money you're putting away is for your retirement. and it's not money that you can just put in and take out. You can't just put in and take out. It's got to be locked away. But as I explained at the beginning, it's building up that retirement fund, right, when you get to 60.
Yeah. Awesome, Raj. Thank you for that. That was awesome with delving deep on that and thinking about how we can, really build ourselves up from a lot lower tax bracket, for our future and living tax free, with those amounts at a later time, which is awesome, right? That's what everybody loves, right? Not paying tax on stuff.
Yeah, exactly. Keep your money. Keep your
money. Exactly. Let the government has enough of it. Let's keep it as much as we can. Love it. So let's talk more about international structures now, because I know obviously you do a lot of work with international businesses. So how should we structure things, either if we're coming into Australia, for business overseas, or maybe if we're going overseas, we're an Australian business. You've mentioned some of the big ones you've worked with, and we're going overseas as well.
Yeah. So international tax area is probably a complex area, Athin, right? So I'll make some comments. At Grant Thornton here, we have a corporate tax team. We've got lots of partners specializing in international tax, right? Who would sit down with the company and work out their strategy, right, as to what their exit plans are, what markets they want to access, right? Most people say US. I want to go to the US because that's big. I want to be in New York, right? But we sometimes say, look close by, right? There could be markets in Indonesia or the Philippines, right? So markets closer to home, right? Generally, we have corporate structures. So we're not talking trust. We're not talking partnership. We're not talking individual. If you're starting an international business, Athin, it won't be Athin, right? Starting an international business, it'll be his company, right? Because we want the asset protection because the risks are bigger, right? Because you're going to overseas markets. So generally, we are looking for a holding company, right? We are looking at the residential status of the shareholders, right? Where are they living, right? Where do they plan to live in the future, right? Because that has considerations too, right? For example, Singapore, right, is an ideal place for people to locate because there's no capital gains tax in Singapore, right? New Zealand doesn't have capital gains tax, right? Singapore, the corporate tax rate is 10%, right? Whereas in Australia is 30%, right? So we look at the markets you're going to go to, where the talent is going to be, right? Where are you hiring people, right? So I'll give you an example of a company that I worked with maybe a few years ago. That may be a good example, right? Technology company, I won't mention the name, 3 founders, right? They built up a team over about 8 years. Their plan was to exit at 100 million, right? 18. So there were 3 young guys, right? They were probably in the late 20s. We want to sell for 100 million, right? It was 2012, I think, and they sold, I think, in 2018. They sold for 85 million. So that's not too bad. They wanted 100 million. They got 85 million. And they set up started in Australia, went to Singapore, went to the Emirates, went to Dubai, because their anchor client was Emirates Airlines. So they did all the booking systems, the apps, and so on for Emirates, right? So they set up in Dubai. They had an office in London, and they had an office in the US, right? And management team of three founders and their CEOs in each of the cities, right? And about 200 people, right? 200 workforce. So we kept their structure in Australia because the founders were in Australia to start with, but they moved to Singapore. Interestingly, right? They said, this is where we need to be, right? Singapore is a bit closer to the action, so they went to Singapore. And they went to Singapore in 2012 and the company was valued at 2.5 million. So at 2.5 million, when you depart Australia, you pay what's called a deemed capital gain at that time, and they paid the capital gain on 2.5 million, right? It did hurt them at that time, right? At 2.5 million, you still need to write a check to the taxman. And think of them, they're young guys, early, didn't have much money, but they had the vision to grow to 100 million, right? So the advantage was then when they sold for 85 million, the difference between the 2.5 and the 85 million was not subject to capital gains tax because they're gone overseas, they're become non-residents, right? They were living in Singapore. They're probably still living in Singapore. I think they're traveling around the world now. They haven't come back to Australia yet. So that strategy worked for them, right? So to cut a long story short, so we look at what countries, right? Tax rates, right? The residencies of the shareholders, where are they living? Where do they intend to live? Where do they want to get an exit, right? We look at IP. IP is a big thing, I think, intellectual property, because everybody wants intellectual property, right? So, for example, Atlassian, the Australian government wants the IP to sit in Australia because it's an Australian company. So the IP tracks the amount you can tax, right, generally. So Facebook, for example, the IP is all offshore. So whatever we do, we have done complex tax reform in Australia, right, around these multinationals, But the difficulty is, whilst ever the IP sits overseas, there's always structural mechanisms to tax money in Ireland or tax money in the US, right? And I actually listening, interesting, I want to mention this to you. I watched the State of the Union address last night by Joe Biden, right? And I was watching it at midnight last night. He actually made me watch it, right? And he only made one gaffe, so that was good. You know, I think he said Iranian as opposed to Ukrainian at one point. Everybody laughed. But apart from that, everything else was pretty good. And he said, look here, I think he talked about Intel, right? Intel, which is obviously a chip maker in the US. And you know, you probably heard there's a big scarcity in chips, right? So car manufacturing is suffering at the moment, or there's lack of supply of automobiles because the chips are not available. And how that Intel is going to be investing, I think in the order of about $20 billion in a greenfield site in the US, right? And how he needs to encourage these companies to be in the US. Because in the past, what they've done is they've gone to Ireland to get a lower tax rate or whatever, right? They've gone overseas. So he talked about a universal tax rate, which is what the OECD is also going towards. Is say we're going to take any tech company like a Microsoft, which is a $3 trillion company, mind you, Athin. So you know these companies have grown significantly during COVID, right? And say, look, it doesn't matter where you set up, right? It doesn't matter where you do. You go and get your talent, get your whatever. They're going to tax you 15%, right? So we're going towards a universal tax rate. This is where the OECD is pushing for, right? So which then takes out people wanting to go and set up in jurisdictions just to get a tax advantage, right? So I think that's where it's heading towards, and he wants to do that in the US. I think the previous president, Trump, whether you like him or not, right? One of the things I liked about him was that when he came in, he went from a US tax rate of 30% or 36%, fairly big number, 18, right? Bigger than Australia, to 21%. And his motivation was, if I go to 21%, my companies that are going overseas, American companies that are going overseas, will come back to the US and invest in the US, right? And Joe Biden is following that as well now, right? So it's a more even playing field that people are not manipulating the tax system, right? And I can remember, the last thing I can talk a lot about this, they had Bill Gates come to Australia once, and he was at the University of New South Wales, and they said, Bill, he's one of the biggest philanthropists, right? So the Bill and Melinda Gates Foundation, I think, put in, $20 billion, right? The biggest foundation. So he gives away a lot of money. But they asked Bill, one of the students asked Bill, do you think it's fair that Microsoft pays, sets up in Ireland, pays, 10% tax or 5% tax? And, is it ethical? I think that was the question asked, right? And Bill said, there's nothing about ethics here. We structure according to the rules that are there. We're not breaking any rules, right? We don't believe there's an ethical concept. We will set up where we think we get the best outcome for our people, for our shareholders, right? And then to invest, because they invest a lot of money in R&D. So that's what it comes out of. So that we need to simplify the rules. Otherwise, people will always find ways of breaching the rules, right? So we are heading towards this universal tax rate, hopefully, which will simplify the rules, right? But I say international Athin is complex. Depends on every situation, right? And we sit down and we understand the journey, and then we structure accordingly with the experts.
Yeah, awesome, Raj. Thanks for that. That's great to open up our awareness on different possibilities and how the international tax system is working right along Australia. So very interesting, and just delve deeper into slightly maybe about IP, right? Where it's obviously important whether you're a local business, an international business, about where to keep the IP, like you said. Now, from my understanding, there's normal people would just put it in the same company as an example, but I know that there's benefits of maybe putting it in a separate company, right? Of maybe there's like people might do licensing or other areas there with how IP is, and then maybe for when business is sold and things like that. So do you want to maybe share a little bit about, different ways of structuring the IP as well?
Yeah, so generally within a group of companies, right, I think we would keep the IP separate, you're right? It's just an asset protection strategy, right? So let's say a company gets into trouble, it operates under a license from the IP owner, right? A company has gone into trouble, this company can go into liquidation. As you know, companies can get into trouble, right? That's the reality, right? And we've had a lot of that during COVID as well, right? Companies going to administration. I think recently there's a big construction company with $5 billion worth of contracts going into administration in Australia, right? A South African-based company. So yeah, so it's an asset protection mechanism, right? So where we keep the IP, right? And let's say, Atlassian, for example, probably has its IP. I don't know their structure, but probably has its IP protected, right? Both, it could be domestic IP, it could be international IP, right? There's a difference between the two, right? let's say you're going to Japan, for example, you might have to modify your code to suit the Japanese requirement, the Japanese language, and so on. So you might create Japanese IP. So internationally also, it can be different IPs, domestic and international IP. There are all ways to quarantine the IP in a company to give you that asset protection, so that if a trading entity or an operating entity gets into trouble, we can just deal with that entity, wind it up, right, and then carry on because we've got the IP. And also the licensing as well. For example, let's say your IP, right? For example, Athin, the business growth IP, you might have IP, right? Well, obviously you have IP, right? So you might put that in a company, and you might say, okay, you might find consultants in other markets who want to run the business growth show, right? And you might say, okay, you can use my IP under license, right? I will train you, I'll show you the IP, whatever, and I'll charge an IP fee. So allows you to now, that IP company sits separate, almost like an investment company, because it's got IP, it's going to earn a return, like a royalty, right? And you might say, okay, you can do it for every dollar that you make out of the business growth show in London, I'll take 5% or 2%, right? And so it allows you to keep that separate and deal with other parties. So it's a way of growing your business as well, right? So it's not only are you using the IP for yourself, you're now using IP to promote your business and allowing other people to actually use your IP and generate a living, right? And get the message out there. So IP is very important, and it's also linked to tax as well, as I mentioned earlier. Where the IP resides, the income generally follows, right? So if your IP resides in Singapore or Hong Kong, your income is following there, and then from a tax point of view, right, you're getting a better tax outcome too. So IP and tax sort of got to work hand in hand.
Yeah, awesome, mate. Love that. Thanks for sharing that and getting us thinking about how we structure those things as well. So let's talk maybe a bit more about working in the industry, right? So you've been in chartered accounting now for 30 years, and I'd like to hear what it's like. How has it changed, right? Because 30 years ago, there's been a lot of changes in terms of laws and things like that, as well as just generally how we're working these days. So what's it like now, like what it was before to now, working in the chartered accounting industry?
Yeah, very interesting question, right? And this is something we're grappling with now. It's, all the firms are grappling with, right? We're working with millennials. I don't know what the next generation after the millennials is. There's another one. I forget the term for that, right? Young people, they are very enterprising. They want to learn quickly, right? If I go to a career fair, they'll say, Raj, how long did it take you to become a partner? I'll say, oh, it took me 12 years. They say, oh, that's way too long. I want to be a partner in 3 years, right? So the profession has changed, and that's because the technology has changed as well, Athin, right? So 30 years ago, we had double entry bookkeeping, right? We had ledgers, T accounts. We used to do debits and credits and manual ledgers and whatever, right? Now it's all computerized, all automated, right? Systems talk to each other, whether it's an Oracle or an SAP, or at the lower end, MYB or a Xero, for example, for small business. It does everything, right? It talks to your bank, it downloads the bank statements, downloads the credit card statements. So it's all automated, right? So the change is, people want to be advisors, right? So advisors, I'll quickly give you, I think, an example here. So Deloitte and PwC, the two biggest firms, right? They were battling for number one status in Australia, right? And Deloitte under I call Guillaume Swiggers, who came from South Africa, who led Deloitte, right? Probably 10 years ago, right? He ran on diversity and technology. He said, look, our point of differentiation is diversity and technology, and we want a diverse team, especially females, staying to become partners, right? And bring that diversity of thought. And then technology. We're going to invest heavily in technology. And then PwC was left behind. So at that time, I think maybe Deloitte went to a $1.5 billion firm, and PwC was left behind, right? 1.2 or whatever it is. So they brought in a guy called Luke Sayers, who stepped down, a young CEO, who stepped down probably a couple of years ago, right? And Luke said, okay, what do we do, right? So, these guys are running technology and diversity. So he said, we're going to do L&D, right? So I read the article in the Fin Review, I can remember at that time. He went to the head of L&D and said, how long does it take to train our people up to become advisors? The L&D said, oh, our program, Mr. Sayers, takes about 8 to 10 years. This is my understanding. I'm just improvising here, right? This is my words, right? I wasn't in that meeting, right? I said, said, okay, cut it down to 2 to 3 years. Cut it down to 2 to 3 years, right? Train them up to become advisors in 2 to 3 years. And lo and behold, PwC beat Deloitte and is again now the number one, the largest firm. I think it's got to about pretty close to $2.5 billion in revenue in Australia. Globally, it's a 40 billion revenue business. In Australia, 2.5 billion, which is pretty heavy for Australia, for a small country, right? So they're doing really well. They're in Barangaroo, which is this way, down this way, right? They've got nice offices as well, I think. So fancy offices. You can walk on treadmills and do meetings whilst walking, right? So yeah, so the culture has changed. It's all open plan, right? No longer our partners sitting in nice, massive boardrooms, sitting there and say we are untouchables, right? They're sitting out there, with the people, right? Trying to, it's an advisory-led approach, right? Because the machines or the computers and AI is playing a big role as well, will do all the number crunching. So it's up to the individual. Let's say your son, Ethan, I know you're getting married soon, right? He wants to be a professor, he wants to be in the chartered accounting profession, right? Yeah, he's going to be an advisor, right? He's not going to be an accountant. We do not use the word accountant anymore, right? He's going to be an advisor. He's going to be somebody who can interpret the numbers, right? Have a discussion with his clients, help them to grow their business, right? Improve profitability, improve cash flow. Those are sort of things we're thinking about, right? Leadership, I think, is a massive thing. So we would love to put people, through your show, for example, to come and be mentored by you, because it's all about leadership. So when we hire out of the universities now, no longer do we say we want 99.9% UAI. Show me somebody who can stand in front of an audience and talk, right? Who can build relationships, who can work in a team, right? I mean, these are the things we're looking for. So it's very different to when I started. When I started, I was just number crunching, right? Doing bank reconciliations, number crunching, photocopying documents. Now it's all about leadership, LinkedIn. Are you going to be an advisor? How are you going to hold an audience? How are you going to communicate? How are you going to listen? All those things, right? So it's very different, and the people who can succeed in their environment will thrive, right? Unfortunately, the people who can't do that or don't want to do that, not that they can't, they don't want to do that, won't succeed, right? So it's going to be one of the highest disrupted professions, Athin. It's going to be the accounting profession, right? Hairdressers, not so much, right? I don't know whether you need a haircut, Athin, how often you need one, but hairdressers not so much disrupted. They're at the bottom end, accountants at the top end.
Yeah, love it, mate. Thank you for giving us an inkling of where the industry is going and how people can be successful and how it's all changing, which is pretty powerful there, mate, and how, we're all evolving in how we work together and growing. So powerful session, Raj. It's been so awesome to connect. So, we connected through our networks where I learned about your awesome journey, which spans over 30 years to date, across assurance, accounting, taxation, consulting, and business advisory services, where you've worked with a variety of people and entities, in multiple countries. You're an awesome guy, so knowledgeable. I'm sure everybody would agree today, and I'm sure you continue to help, technology, media, and fintech businesses succeed. Very grateful that we connected, and I look forward to working with you in the future. So, Raj, how can people find you and get in contact with you?
Yeah, thank you very much, Athin, for those kind words, and really great to be on your show. I followed your show over a number of years, and I said to you, I want to be on it, and you kept saying, okay, what are we going to talk about? I'm glad that we found something to talk about. I'm not as exciting as some of those high-profile people that you interview, but I'm still very grateful that you had me on your show, and I really obviously enjoyed meeting and collaborating with you. We are on LinkedIn. Grant Thornton Australia is on LinkedIn. I'm on LinkedIn, Raj Deepan. raj.deepan@au.gt.com. Obviously find me on LinkedIn. One of my things I like to do is be responsive to my clients' requests. So I'll be there. If you've got a question, more than happy to have a meeting. The clock is not running, right? More than happy to have a coffee, have a drink, catch up over lunch, and help. Basically, at the end of the day, my passion is to work with clients, work with companies, work with individuals, even young professionals. If they need some mentoring, more than happy for them to reach out to me, and I'll open the door into Grant Thornton. I'll say, I wake up every morning thinking I'm one of 55,000 people, right? Our culture is all about people. In Australia as well, we've got our care strategy, which our CEO launched. It's caring for our people, caring for our clients, and caring for our community. So, we work around the care philosophy. So it's about doing the right thing by our clients. None of our partners, we've got 180 odd partners in Australia, 1,200 people in Australia. None of them are out to make a killing from a client, or they see an opportunity where they're going to charge $1 and make money, right? It's about doing the right thing and being there for the journey. So so hit me up on LinkedIn. Happy to have a cup of coffee anytime. And obviously, we've come through a difficult time, Athin. The world's obviously going through a lot of change, right? But the world has actually become closer as well. So there's a lot of collaboration happening. We're collaborating a lot better across our 130 member firms. We're collaborating a lot better across Australia, right? So it's all about collaboration and lots of good professionals as well as support like yourself. What you're doing is fantastic, what you're doing, and we obviously need to talk more about that. Yeah, so all the best to everybody out there. Go and do what you have to do and seek the support, and that's the way to do it. No one person can do it by themselves, Athin, you know that, right? So it's about smart collaboration. So having the people at your table who are going to help you along the journey is the way to go. So anyway, I'll leave it at that, Athin. Thank you very much again for having me. It's been an absolute pleasure to be on the show with you. I've enjoyed every discussion we've had today, and I'm sure I'm going to enjoy every discussion for the future. And I know it's a big year for you, Athin. So wish you all the best for this year.
Yeah, thanks so much, Raj. Amazing stuff there. And thank you everyone for watching and listening to this show, where we talk about everything on business growth. Please like, subscribe, and leave us a 5-star review. You can find me on Facebook, LinkedIn, Instagram, and YouTube as Athin Cassiotis, or visit my website, athincassiotis.com. I completely agree with you, or do I? The only way you will know is if you tune in next time. So until next time, remember that our business grows when we learn skills and take action using them in spite of fear. So remember to design your growth and results.